Hi, everyone. Welcome back to the Data Minute podcast. My name is Peter, head of insights here at Carta. Today, it's another solo episode, this time about the most requested topic for this podcast, AI funding and valuations. AI is the hottest thing around startups, and it has been for the last few years. I'm going to walk you through a little bit about what Carta knows about the state of AI funding, who's getting AI funding, what the valuations are for these early stage companies, and how fast do you really need to be growing in order to get into that elite cohort of startups. Chart number 1, how much capital is flowing into AI by stage? So if you look at this chart, this just shows you that in contradistinction to many of the trends in venture, this is actually a bigger deal at late stage rather than early stage. So nearly half of every dollar invested into a late stage company in 2024 was invested into an AI company last year. That is a wild number. And even with the early stage numbers at about 25 to 30% of funding, you see that those mega rounds, the ones we all read about in TechCrunch and other places, they are truly dominating the landscape. I think it's something like a handful of companies, 10 to 15 companies, have raised more than half of venture funding in 2024. That is a new sort of paradigm. But where do these companies live? Let's jump into chart number 2 and look at a little bit more on location. All right, it should come as no surprise that many of these companies are located in the Bay Area and San Francisco in particular. If you look at this by stage, about 45% of the AI companies that get funded on Carta are in the Bay for seed and Series A stages. But by the time you get to late stage, call it Series C, Series D, and beyond, that number rises to 3 in 4 companies. So it really is true that the white-hot center of the AI funding boom and cross startups is happening here in SF. I'm going to dig a little bit now into more around the valuations of these early stage companies, which have changed rapidly over the last couple years. So here's chart number 3. Chart number 3 digs a little bit closer into valuations and cash raised. So to give a little bit of context, the valuation of these companies is stated here as the pre-money valuation. That is the dollar figure that these companies are valued at before you add in the cash raised from the round. In 2022, 2023, there was a healthy premium for AI companies that has only expanded into 2024 and 2025. In fact, that we see that software companies that are AI native get about a 40% valuation premium to software companies that are not AI native. And of course, there's a lot of debate about how you tell an AI native company from a non-AI native company when it seems that everyone has adopted AI technology at a very rapid pace. I'll leave that up to the investors to make better choices than I would. But this change in valuation is also mirrored in a change in round size, meaning AI startups raise bigger rounds at higher valuations, and they do so faster than typical traditional SaaS businesses. You add those 3 up, and there really is a big premium for being an AI native startup in today's market. You're more likely to get in front of more investors, and you fit the current thesis in a way that non-AI startups just are falling behind at the moment. If we move then from chart 3, which was around seed stage, to chart number 4, which is around Series A, you see that a similar, though slightly less dramatic distinction occurs at this stage. So we see about a 25 to 30% premium for Series A valuations for AI startups against, again, the non-AI software cohort. I'll be honest here and say that when we speak to investors every day here in San Francisco, it's pretty rare that they see a pitch that doesn't involve AI in some way, shape, or form. So that's less true outside of the Bay Area, but it's becoming more and more true with every passing quarter. In fact, I wouldn't be surprised that if in 2 to 3 years, we stop reporting on AI funding as a separate category, and we simply assume that all software businesses are using AI in some way, shape, or form to help them build their companies. The last note that I'll make about Series A valuations is that there's a distinct barbell happening here. So the chart shows the median, but there's often really extreme outliers that can sway things one way or the other. I mean, you see AI companies raising at $100, $150, $200 million for their Series A, and they might raise $30, $40, or even $50 million during a single round at this early stage. That is net new behavior. We haven't really seen that across startups until this past 18 months. All right, the last couple charts are actually, I've taken them from the Bessemer Venture Report. So they recently just put out a report called The State of AI in 2025, and I found some of the findings fascinating. So their first chart, They broke up AI benchmarks into what they're calling supernovas on one end and shooting stars on the other. So a supernova company is one of those AI elite companies that is growing at unheard of paces. They might be at a $40 million ARR in year one, and that might jump to $125 million of revenue in just 2 years. That is crazy fast. But how are they generating all this growth? Well, it certainly isn't by saving money. They are burning money like there's no tomorrow. In fact, many of these supernova AI companies are actually gross margin negative and have been their entire existence. If you look at it on a team basis, some of the best benchmarks suggest that these companies earn over $1 million of ARR for every full-time employee on the team. So that's the supernova category. There's a class of AI startups just below supernovas that Bessemer has termed shooting stars. These feel like an enhanced version of what we had before, less of a completely new phenomenon like the supernova AI. So you might have $3 million of ARR in year one, jumping to $12 million of ARR in year two, and then $40 or so million of ARR in year three. That's fast, but it's not completely unheard of. What these shooting star companies have in distinction to those supernova cousins, though, is they actually have gross margins that make a little bit of sense. In fact, many of them have gross margins around 50 to 60%. That's not necessarily SaaS level. It's a hell of a lot better than burning $2 for every dollar you spend, like some of these massive AI companies happen to do. All right, let's look a little bit about the growth rates of these companies and how they map to the old world. We'll call it the pre-pandemic world of the cloud giants. This is a fantastic chart. It shows you how quickly each one of these cohorts gets to $100 million in ARR. So for the supernova category, again, this is brand new stuff. The estimate is that some of them will get to $100 million in revenue in 1 to 1.5 years. That is wildly fast. That is a completely new paradigm in startups. No company that we've seen over the previous eras across startups has ever moved that quickly. You've got shooting star companies that get to $100 million in, call it, 4, maybe 5 years. Again, that's moving very quickly, though it's still a little bit closer to those old growth rates. And then if you look at the cloud era, you would see that the more traditional 7 years to $100 million of ARR appears for that cohort. So we've looked at AI valuations. You've kind of seen the growth rates of these AI companies, but what does it mean if you're an early stage founder just starting out? I think there are 2 clear takeaways. The first thing is that the bar has been raised. Every single venture investor that you talk to now has some of these examples in their mind when they're thinking about whether or not to invest into your startup. Is that fair? Not always, but it is the way the world works. I mean, if Cursor and other AI native companies are moving at a $100 million revenue pace per year, that is obviously going to influence the investor's decision to invest into your seed or your Series A round. That's the game on the field. The second point is that there is now a trade-off that has become clearer and clearer between incredibly fast growth on the one end and unit economics and profitability on the other. Given the choice, a venture investor would obviously want you to have both. But usually, if they have to pick between the two of them, they're going to pick growth. And so a lot of founders who are caught between wanting to both maintain profitability and grow as quickly as possible, you may not be able to do both. And usually venture will push you towards the growth side of the equation rather than the profitability side. This suggests one thing: you don't necessarily need venture money, but if you're going to take it, you are committing to someone else's growth path. So be very specific and thoughtful before you jump into a funding conversation with a VC, if that's not the kind of company that you want to build. All right, I hope that recap of both the data and a little bit of advice for you as an early stage founder is useful. We're going to package this all together into an AI fundraising trends report. So look out for that on carta.com/data very soon. And if you have other ideas about deep dives into venture topics that you'd like to hear, I'd love to hear from you. Thanks so much.